When it comes to retirement planning, the most important decision that you will make is not how much to save, but choosing what funds to invest in. Solid, reliable funds will promote early retirement, but playing it too safe could mean your life savings stagnate for years with no growth at all, and bubble, speculative funds could see your money disappearing down a hole. The problem is there are just so many funds to invest in, and it isn't always obvious which ones are winners and which ones are duds. Most of the mistakes that fund investors make are behavioural or psychological, so they can be quite difficult to avoid and eradicate. In this video, I'm going to talk about mistakes fund investors make and how to avoid them. When we start researching a fund, the first thing we look at is past performance, and this is the root of the problem. We want to find a fund that's gone up the most, as we think that this trend of success will continue. I'm guilty of this, as you can see that I make videos about funds with a good track record and not about laggards that might come good, when what can sometimes happen is that the losers of the last couple of years or so become the best performers over the next, say, 24 months into the future. Back in 2020, Scottish mortgage was all the rage, with price rises of 5 to 10% each month, and hardly anyone was saying, wait a minute, this isn't sustainable. What ended up happening was mean reversion, and the share price reverted back towards a more longer term and sustainable growth rate, as is illustrated in this chart here. So at the very time when it seemed like it's such a slam dunk to buy Scottish mortgage, it was actually a horrible time to buy it. So how do you avoid mean reversion? Well, one thing to do is to invest in funds that have a very strong trend and a sustainable slope where the growth isn't too excessive year after year. If there's limited deviation from the mean, then mean reversion can't be much of a problem for you, as is illustrated by this chart of Wisdom Tree Global Quality Dividend Growth. You can use mean reversion to your advantage, as is illustrated here by the price of Fundsmith, where the price is below the long-term trend line, then it's a potential buying opportunity, and where it's above the long-term trend line, then it's a possible chance to take your foot off the gas and consider maybe moving funds elsewhere. We see mean reversion and bubbles in various funds everywhere. This is clean energy, and this is China, where investors thought there was some potential growth in the market, but it turns out that really the long-term growth is almost zero. I use some Google Sheets to help me with identifying trends and identifying low deviation from the trend, and here's screenshots from a couple of them. If you're interested, my contact details are in the description. When researching a fund, we have to remember that past performance might not repeat. Apple might not invent another groundbreaking product like the iPhone, and in emerging markets, you might not have a phenomenon like South Korea, where it goes from war desolation to becoming a top 10 economic power. Linked with buying funds that have gone up a lot and diverted from the mean is selling in panic, and investors often can't differentiate between short-term volatility that's just natural for any share or any fund, and medium to longer term structural change where business or markets have changed and there is likely to be some kind of difference in the performance of the fund going forwards. And then finally, they maybe even think there might be a permanent loss for the fund, and that's why they sell in panic. And the way to overcome this is to, again, do some detailed research and maybe try and understand the differences between these effects. Linked to selling in panic is confusion over setting a stop loss. Typically with a share, you might set like a 20% stop loss, but hopefully with a fund, because it's quite diversified, the price will come back, and over a longer term period, such as 5 years, you're unlikely to see a loss. But the problem can be that in the shorter term, you might see fairly steep declines in price, and then you'll be confused as to whether to sell and move on to something else, or whether to ride out the storm. In the same way that fund investors chase prices, they also chase high yields. And what they don't understand is that anything with a high yield is reflecting the risk-free returns that they could get from, say, like an overnight money market fund, with the risk premium associated with the relevant fund. And so funds with high yields are often seen as high risk. And so there's a likelihood that they'll either cut the dividend in the future, or there's some uncertainty around the assets that underpin the fund. And many high yield funds are quite esoteric, they're quite non-standard, can be very difficult to understand. So it's better off to go for a fund with a reasonable yield, has a long track record, doesn't deviate too much in its price, than really just chasing the highest yields and then ending up being disappointed. Solution to chasing high yields is to focus on funds that have more of a quality dividend bias to them. Here's a list of some US companies that have increased their dividends each year for the last 50 plus years. And we see familiar names here like Johnson & Johnson, Pepsi, and Coca-Cola. So there's plenty of ways to invest for a yield that are underpinned by solid economics. Another mistake that fund investors make is over diversification. The problem is that there can be high correlation between equities, even if they're small cap or emerging markets. They all tend to go down at the same time if there's a major economic downturn. So the problem is that too many funds can lead to a lack of focus and a lack of objectives as to what you're actually doing with your portfolio. It's often better to have just a few top quality funds and to know exactly what you want from your portfolio. When selecting a fund, you could just go for one from a broker's list of recommendations. They come from things like Hargreaves Lansdown and Interactive Investor. Also, websites such as Morningstar have ratings for their funds. But the problem is that these rating systems are generally very opaque. And the reasons for this is to stop fund managers from gaming the system such that their fund automatically goes to the top of the ratings. So if you do decide to choose from a recommended list, you could end up with just an average performer, and you could be confused as to why the selection has been made in the first place. The top 10 holdings of a fund are often very misleading. It will generally contain the winners that the fund has been able to select and not the losers. The shares listed are often ones the fund has held for a while. They've been quite solid performers, hence they've risen to become a larger proportion of the fund, whereas the losers have generally moved out of the top 10 and into the lower reaches of the fund that you can only find in the report and accounts. And even the report and accounts of an investment trust can be very misleading. Generally, there's lots of words, lots of pretty pictures. It's really just a marketing tool. It's talking about all the advantages of the investment trust and why it's so great. And there's hardly any mention of the risk or how they go about managing risks in terms of the selections that they make. So you really need to read these report and accounts with a bit of a pinch of salt. A big problem that investors have when researching a fund is that it's pretty much impossible to ascertain whether the strong performance of a fund is due to the skill of the manager, or it's really just down to luck. And often outperformance comes from things like picking the right countries, sectors, or factors. And that can be sometimes more important than the very specific stocks that are selected. So, for example, over the last 10 years, if you'd had a decent weighting towards US technology and quality within that, then you would have done well. And it's more that methodology that would have helped you rather than whether you picked Apple or Microsoft. So the problem is that fund investors need to really dig behind the objectives of the fund and the selection process to really understand that, and then hopefully they can get some indication of whether it's skill or luck that has generated the outperformance. When selecting a fund, investors generally have a lack of appreciation of risk. And by this, I mean they don't understand what could possibly go wrong and why the fund could potentially underperform and not meet the investors' objectives. Fund fact sheets have a table that looks at risk where there's a rating between 1 and 7, but unfortunately this isn't terribly useful. Here is Scottish Mortgage and it has a risk rating of 6. And then here is an all-world tracker that also has a risk rating of 6. But surely Scottish Mortgage is far more risky than a global tracker. And the problem is that the global tracker includes emerging markets and it might at times use small amounts of derivatives to achieve its returns. So that's why they seem to be rated the same. And yet Scottish Mortgage has a raft of unprofitable companies and unquoted companies that can create a lot of volatility in its share price. So arguably it's much higher risk. You might think that a bond fund, particularly a government bond fund, isn't particularly risky. So here we have a Vanguard bond fund and initially the chart looks fairly reasonable. Unfortunately, the hidden risk in the bond fund was interest rates rising from 0.5% to 5%, and then suddenly the price of the bond fund collapses. But this isn't always obvious to fund investors, and the only way to get around this is to do detailed research. I offer portfolio coaching where I review your portfolio and come up with ideas but not advice as to how you can maybe restructure your portfolio. If you're interested, go to my website www.ianshadrack.com/portfolio-coaching. A lot of the mistakes fund investors make can be overcome by having a much more rigorous research methodology and more rigorous objectives as to what you expect from a fund over what period of time. If you want to learn more about that, watch this video here.